Today's episode is brought to you by Treston Associates. Treston Associates provides a growing suite of back-office services to mortgage brokers. One of their most popular services is mortgage fulfillment. Treston Associates will handle the fulfillment of your files on a per-file basis. No monthly fees and no commitments. You have a team of experienced professionals working for you without the headache and expenses of payroll, training, and turnover. Get in touch with Treston Associates today by visiting their website, tresstonassociates.ca, and book a call for a fee evaluation of your business. You can also click on the link in the description. Treston Associates is helping mortgage brokers scale their business. Contact Treston Associates today. Welcome to another episode of Real Estate Tribe. We're your hosts, Harris and Umar Zulkarnain. How's everything, Umar?
Good. Exciting episode today. A lot of interesting news happening in the real estate world.
I mean, there's a lot of new subjects coming out, like every single day. There's sensational headlines, and I feel like to really kind of understand what they're saying or what the numbers mean, you really not only have to understand what's going on in the market right now, and you have to be fully immersed, but there's a lot of historical context as well, just because there's a lot of storytelling and understanding how we got here, where we're going, and to put everything together, to piece that puzzle together, it only makes sense to kind of really understand all of that in order to understand what you're reading.
Definitely. I think often headlines are focused on whatever gets the most attention.
Yeah.
And what's missed is the context and what's beneath that maybe that data point that just sounds more exciting and will get more clicks. What does it mean? What happened before? And what are the real implications of that information?
Yeah. So definitely. And to kick things off, I wanted to kind of start talking about a research note that came out by BMO Capital Markets. And they just basically explained how the Canadian real estate market in the past 2 years was one of excess demand. And that if you look at like where our listings are, we're kind of going back to pre-pandemic levels. So the number of transactions that are occurring are similar to, I guess, pre-2020. I know that I think it was 2019 when COVID was about to hit, we had a dip, and then we have a surge, and now it's kind of going back to what our median average is. But the funny thing with this is, and I want to spend some time talking about this, is because they say that there's excess demand, and we're going back to normal, but it doesn't take away from the fact, even though we're going back to normal, rents are surging.
Yeah,
right?
it's ridiculous. I think a 20% increase in the past couple of months.
Yeah, so it's something really high. And so is there really excess demand if there's rents? Like, people have somewhere to live. I would assume excess demand is interest rates are low. So people are refinancing and buying properties that maybe are sitting vacant, and maybe there's nobody there. But if that's the case, sooner or later, if everybody's not flipping it, like you'd go into a lot of bankruptcies. And if you're not seeing that, that means that there's the rental market is strong, which means that is there excess demand? It's a different story if, for example, you own 2 homes, right? And I need to rent, and I rent one of your homes. I don't consider that excess demand, because that's like an equilibrium, because you've got a home you're living in, and I rent the other home from you in this little small economy that we've got. That's pretty balanced out. There's no excess demand there, even though you hold all of the assets.
That makes sense. But I think looking at the data might provide more insight, because it's possible that you have maybe I haven't seen the rental data, what kind of demographics are you typically renting, but you could have a portion of the population that's maybe a millennial living with their parents, looking to move out, and they're looking at finding a place to rent, or they're looking at buying a place, maybe their first home, maybe their first place out, and just because of the fact that they're unable to get in wherever they're trying to they're priced out of the market, they're staying where they are, right? So instead of entering the market, instead of renting, instead of buying, they're staying maybe longer. And I think there is data to support this, that you have people are staying longer with their families, and it's pushing culturally there's been pressure. I think globally because real estate has been there's been a boom globally, but there's been a pressure towards more moving back towards those. I don't know what the term is, but
Multi-generational kind of
family units.
yeah.
Yeah, exactly. So in that perspective, you could say that it's there is demand, but some people aren't getting the houses, and that's what's driving up rents.
Yeah.
But
I remember before COVID, we went to a talk, and there was a couple of developers there. I don't know if I went with you, but it was
yeah, I think
yeah.
Rotman University. I think they had
Yeah,
it.
said Brad Lamb Group was there, and there's a few developers there, and they were at that point when prices hadn't surged as much. We're talking about multi-generational living, how people were living with their parents. They were trying to divide houses so that if like your kids got married and had kids, like they're giving them one floor. So they're already talking about that before pre-COVID. So now I'm assuming like it's going to be even worse. So when they say like demand's dropped, I mean, is it excess demand or is it pent up demand that you saw where it's like, you know what, as soon as interest rates go down, I can afford this mortgage and try to get into this house. So that's what I'm going to try to do.
Yeah, no, definitely. I think the lower interest rates probably had more participation with investors as well, right? Because everyone wanted to be an investor at the time.
Yeah.
Everyone wanted to enter the market. Now you have maybe more mature investors, people who understand, who have maybe more than one or two properties in their portfolio that are staying in the market and participating more. The casual investors might be more hesitant.
Yeah. I mean, I also feel like it all kind of boils down to just the supply of real estate. I mean, not even just the supply. I feel like it is a lot has to change for this to turn around. I feel like, for example, a lot of the good and the bad, right, with the Canadian healthcare, like it's great that you get everybody gets healthcare, and it's you don't really have to worry about that because I do know of friends and people in the States where that is a concern. It's a huge concern, right? Like every single time I have to go to the doctor, I have to pay X amount, right? So now you're thinking about it twice before you go. But over here, you have that luxury of just being able to walk in. But that also means that there's a lot of central planning. And you need to have the facilities around you. And even with your educational system, everything's kind of more standardized wherever you go. Whereas in the States, it's like the local property taxes help fund the school system, and if you don't have a strong tax base, you're not going to get a strong school system, and so it really ultimately emphasizes or really exponentializes any kind of hardships in a neighborhood. But over here, we level it out much better. So, but that means that when we are developing, you have to just develop in a more organized, centrally planned, concentrated way, which gives a lot of power to a few developers who are going in and they can build as slowly as they want. Whereas I feel like in the States, if you kind of set aside everything I just talked about in terms of healthcare and education, you do have you could easily develop a city. It's easy to kind of go in and build communities, and it becomes not a bit of a race, but it's if the demand is there, people are going to jump in. It's not easy for investors to jump in Canada because there's just so many regulations.
I think the healthcare example is really good because if you look at our healthcare industry, yeah, we get free healthcare. We have a lot of privileges that you don't get in a lot of countries, but then you have a lot of complaints about our healthcare system that I think you can draw some parallels in the real estate space where if I were to go to, let's say if I want to go to a walk-in clinic, no problem, I can go today. Within an hour, maybe at most, usually much less, I can see a doctor for just a common issue, have a discussion, don't pay anything. Mm-hmm. But if I want to go to an ER emergency room or I want to see a specialist, then now I have to wait 4 months, 5 months, a year, depending on the specialist. If I'm in the ER, I'm waiting several hours just to see a doctor. So you have two separate kind of issues. One is where I have the access in a very low service level, the walk-in clinic, but when it's the quality service, to hire more specialized doctors, it's harder to get a hold of them. And the reason being is that we have more stringent rules in terms of the quality of care needed for those specialist services, which reduces the amount of specialists in each area. So that's one of the contributing factors. Now look at real estate. One of the criticisms for developers is that the city generally, this is criticism about Toronto, but I think it applies more widely. If you go to the States, you go to any big city, a big metropolitan, they're very kind of relaxed in the regulations in terms of you have this house, let's say, and you've made a basement unit that you want to rent out. Let's split this unit into two parcels so you can sell the basement unit and the upper unit separately. Or let's allow this neighborhood to be built using cheaper material, lower quality resources, so we can have a cheaper kind of class or category of house so that more people can enter the market. So you have here our emphasis is on quality, and our emphasis is on keeping neighborhoods clean, not having too much kind of the second unit in the basement being sold and have more volume, and that all those constraints lead to less access of housing for people too. Does that make sense?
Yeah, but okay. So you're saying, so I gotta look up this information because I don't really have any context. But you're saying that like the regulations, even in terms of building materials, is relaxed in certain areas. Now, would you argue ethically to have substandard materials be more relaxed in building laws is something that is again ethical? Like, should we have that so that we can like we have cheaper homes, we can enter the market?
I wouldn't say substandard. I would say the quality has to be there in terms of safety. Our emphasis really is on quality in terms of just building more higher quality homes. The standard, the threshold is not simply just safety, but at the same time we have climate issues where in Canada you have to have more of a foundation. You can't just build on the studs or whatever they build in warmer climate areas. So
yeah, so naturally I mean, like if you go to Texas, okay, so this is like it's pretty good like example, not pretty good as in the situation, but Texas has been like going through a lot. Even recently, because they're going through like a crazy heat thing, like heat wave. They were like asked not to turn on the air conditioning. People were kind of saying, air conditioning should be like part of human rights, and or it's something that you need. It's a necessity. All this other stuff. Even when they had that flood to be knocked out of the power grid, the issue with that is if you look at Texas, Texas has some of the cheapest homes. And it's cheap for several different reasons. Like, firstly, you don't really have to build a basement. You can throw on a slab of concrete and build on top of that. That's one thing. Secondly, I do feel like generally the prices of materials in the States is cheaper, and I can get into that for other reasons. But it's cheaper, so yeah, you could like build a more cost-effective way, but then they're not in the power grid. I think like they're not. There's I think regional power grids, and I think in the States there's like two of them, one on the east, one on the west. Even Ontario is connected to the eastern power grid, and because they don't want to be connected, they have their independent power grid. As soon as something happens, it can get knocked off if the overload's too much. Whereas like if you spread it out, like against the eastern like states and like Ontario, where like, okay, well, if like New York needs a lot, you send a lot of electricity to New York. If Ontario needs a lot, you move it to Ontario. But it really just depends on which area needs it, and then you can kind of stabilize it more. But even though that quality is there, what that means is that the prices go up. So would that be ethically correct? Like if we could do that in Ontario, where you know what, like depending on where you are and how much you can pay, either you get your guaranteed power, or sometimes you get power outages too. Would that be ethical just to get people into a house?
I don't think so. I think if there's going to be any, this is an opinion, I would have to get more information to kind of understand the problem. Yeah. But I feel like if there's going to be cuts made or changes made in order to make housing more affordable, if the cost is the issue, that's assuming cost is the major issue, then I don't think that's necessarily the first thing to go, especially because we're accustomed at least here, all of us, including myself, we're accustomed to luxury of having power and comforts all the time, anytime. So that would be a major issue for people generally too, not having access to electricity. And then at the same time, especially in the winter, that's hard, right? It's hard to get accustomed to. I think a more kind of I think a better approach. Personally, I don't know. I would have to do research. Personally, I think what the future holds, if the industry, if rental affordability keeps getting worse and worse, is more rental communities, right? Because then you have centralized costs, build a building, lower rents, like they do in Texas as well, right? So
I mean, there's rental communities. There's big companies in the States that have rental communities across the country. And what I like about that is, like, you can, this is kind of off topic. I'm going in a different direction. But what I loved about that was if you go into certain communities, you know what to expect. So I can rent something in Ontario, and let's say I get a job in BC and I move out there. If the same company's there, then I can have that same experience there. And sometimes it's not even like, it's not like, I know the mindset is, oh my God, like, you're renting, so it's kind of like you can't afford to buy a house. Some people choose to rent, and some of these rental places are pretty crazy. Like, they have pools, they have like 3 different pools, they have courts, they have all this other stuff. And I find that to be, in a lot of ways, better than buying condos in a building. And the reason for that is the rental community is owned by a company. They have a vested interest in keeping costs to a minimal, keeping your experience, making sure your experience is well, and making sure that the rents are as low as possible so they can have the best demand possible, right? This is also obviously demand driven, but I'm looking at the supply side. So, but whereas in condos, I feel like buying a condo and then really the maintenance and all of those decisions aren't in that same person's hand. It depends on the board. And yeah, the board is somebody who is basically they're working and they're volunteer boards. You're really taking a lot of direction from the property management. And so is it always the best decision? I feel like it gets very politicized. And so for that reason, those rental communities, having stuff like that, being able to create things like that would be awesome.
Especially if you're looking at the fact that because of their scale, they're able to offer units at a lower price than buying something and paying for a mortgage, because usually that's a consideration too, right? Having that mortgage payment, that condo fees going out every month.
So. Yeah, and somebody's really just focusing on it. And that's why I feel like it's just a relax. I feel like it all boils down to laws. And because, like in the States, you have so many, majority of 80% of builders are small builders. They'll build 1 or 2 or 3 houses at a time. It's not like here where you're kind of mapping out an entire community. In fact, over in the States, you'll have tons of examples where people have tried, developers have tried, and they've failed. And you just see like desert communities, like there's like nothing there. There's just paved roads and that's it. And that's where things are supposed to go down. So there's like, because there's a huge risk involved there. So you build it piecemeal. Here it's like very, very centrally planned. There's a lot of money involved. If you're like looking to build 100 homes, that's not a small amount of homes, especially in today's prices, where like if on average your house is going for $1 million, that's $100 million. You have to be a very big operation to be able to do that. You can't be a small operation.
And I'm assuming it has a lot to do with city planning, in the sense that how infrastructure is managed is probably different here than it is in a big city in the States, where let's say Toronto is looking to add a 100-unit building in a neighborhood. Their ability to increase their capacity for what sewage, electricity, whatever else it is, might be more limited than a similarly sized city in the States that is used to fluctuations in volume and population, and they're used to having these big changes and accommodating them.
Yeah.
Right. So I think that could be a factor. I know recently I got a letter in the mail saying that they're going to be in our neighborhood. They're going to be doing some upgrades for I think it was a sewage system, because the volume of just the population of people is increasing and their system is outdated, and they need to tear apart the roads and expand the system pretty much.
Yeah,
So
yeah.
so you have that is a thought process when they're approving building permits.
Yeah. But yeah, again, I mean, it boils down to and tying this all back to the kind of what I started off talking about with this BMO report is I don't think there's an excess demand. I think there was some pent up demand that came out because interest rates were low. And as they go up, we go to more of a stable state if you compare it to historical records, but there's still a lot of pent up demand. I don't think it is foolish because this is the foolishness I see, right? They're saying that like okay, from 2012 to I guess it's the chart that they've given to 2022. They're looking at an average. What is it? Residential sales unit 121 moving average is around 40,000 units. So it's a monthly. I believe it's a monthly average that they're looking at.
40,000 sold.
Yeah, so transactions. But how does that stay the same if your population is growing? That
has to be annual.
40,000, 120 month moving average. Okay.
Okay.
So it's I don't think that moving average should stay the same as your population is growing. As you're getting more immigration in, as like it should be trending upwards. It should not be a flat line. So the fact that we're going back to even COVID levels is not like a good thing. It just means that there's again more pent up demand.
So you're saying there is excess demand then?
No, I'm not saying there's excess demand. What they're saying is excess demand is as in like there's just a demand that's created as a result of low interest rates. In that, like,
Okay.
hey, somebody, because you have more money, you want to put it somewhere, you just go buy another house, even though somebody's not renting it. I'm saying that, yeah, you have demand that's created, but it's pent up demand because it's not like you have empty units. And in reality, we need to find ways to be able to build more. Even if it doesn't even have to be cheaper, even if it's at the current prices, if we can build more, automatically prices will go down, they'll stabilize. And even if they were to stay the same right now, because I feel like if they stay the same right now, just because inflation is going up, wages are going to catch up eventually, right? So wages within whatever a few years will catch up because people need more money to survive. That's what always happens, right? So as they catch up and it takes some time, pretty soon, like $1 million home, depending on how much you earn, is not going to be what $1 million home was. Like, I mean, if you look at 10 years ago, 15 years ago, when our parents bought their first home, $1 million home would have been like, what the heck is going on, right? You could get like condos downtown for 50, 60,000, right? So it's like now you can't even dream of that. Like imagine a $50,000, $60,000 condo. That's happened in our lifetime. In our lifetime, that condo that was 50, 60 is $500,000. It's the same thing because it's all relative, right? It's all about salaries. So if like your average salary, I remember if coming out of undergrad, if you made six figures, 100 grand, your life is made. Now, if you make six figures, you'll be able to survive. It's minimum wage, right? It's just that the money's worth less. So now if we move forward and the new minimum or average wage in Canada becomes 200,000, then $1 million home isn't as bad, right? Which I feel like is going to happen. So if we just keep building more and have the prices kind of stay where they are, and wages are going to catch up and things are going to get cheaper, it just gets better over time. But we have to look at it from more of a 10-year, 20-year plan, and we got to start looking at laws as opposed to quick fixes that are bring the interest rate down or bring the interest rate up. Like it's like that doesn't really mean anything. You need to look at more long-term structural changes in order to be able to kind of mitigate this issue.
Yeah, no, I agree. I think there's so many factors involved. Making sure the real estate supply is matching, keeping up with the demand, but at the same time, there's the economy as well. How growth is being spurred by the government as well through policy, effective policy. So there's so much involved, but yeah, there's definitely I think opportunity to fix the issue, I guess.
Yeah.
So next, what I wanted to also talk about was there was a report by National Bank where they're sounding the alarm on housing affordability, there's a number of actually institutions over the past few months that have been talking about this issue. And the most recent kind of data point was that currently in Canada's real estate bubble is so big that households need 64% of income for a mortgage. So that's a sizable amount. So 64% of every check is going towards the mortgage. And that does not leave much, especially with soaring inflation, rising food costs, gas prices, for other things, right? Just managing a family, kids, expenses, or anything comes up that's a major expense. So that's been a major kind of data point that's been thrown around on headlines, talked about a lot. And one of the interesting points I think was that a similar kind of spike happened in relation to housing prices compared to income in 1984, where mortgage payments were more than 100% of the median income. So the average person would be in the negatives per month to be able to afford a mortgage. And then that was followed by a major correction. And then over the next few years, then obviously then prices went back up. So what is the correction? The prices crashed and then they slowly started increasing again. What are your thoughts on this?
Yeah, I mean, I think in the 80s, if was it 80s or was it 70s? Like, what do we have any information on like interest rates during that time? Because I feel like interest rates were really high, and because interest rates were like really high, that kind of spikes everything overnight, right?
I don't know the interest rate information, but I do know is that there was a major global recession in the 70s, right? So
Yeah.
I'm assuming based on the recession, you have the predictable quantitative easing, printing money.
Yeah.
Yes, and that leads to reduced interest rates. So I can't quote on the interest rates at the time, but what the kind of the data that was pointed out was just a relationship between your payments on a 25-year amortization and median household incomes.
Yeah.
And how they peaked above 100% and then crashed a year later before slowly starting to climb again. So the point here is that what the data that's being looked at is the percentage of your income that it takes to afford a payment, but it is not. There's no data showing that as of now, prices have started crashing in the same sense.
Yeah.
But what a lot of analysts from these institutions, including the National Bank, are saying is that last time this happened, there was a crash followed by a slow increase again. So they're saying that because it happened before, it might happen again, but we aren't at the same peak as we were at in 1984. So there's room for growth in the percentage of data. You got some data for us?
Yeah, I pulled it up. So I pulled up a chart of like what interest rates were. Bank of Canada overnight rate history. Okay, so you had, and again, like so based on what the graph that you pulled up, well, it's interesting to kind of look at historical numbers. So if you look at like around 1940, interest rate was 2.5%, and then it starts trending up, and then in 1981, can you take a guess like what the interest rate is? I don't know if you saw what
I didn't see, but I'm assuming it's really high, 20%.
Yeah, so it's like pretty close. 18.82% is what this is saying.
Oh wow!
So it spiked, right? And then it started coming down afterwards. So I'm like, it's safe to say it's like that spike in interest rates that caused payments to go up. And
so wait, hold on. So you said 1981, this was a spike?
Yep.
And then 1981 was also the peak for percentage of median income to afford housing. So that 110% amount was in Vancouver. Everywhere else was a little bit lower. And then right after, within I would say, what is this, 1983. So 2 years is where it bottomed out to 50% of median income in Vancouver. And all of the other provinces were kind of similar in the trends.
Yeah. No, so then it's just basically a spike, right? And like, hold on, let me just see if I can, so 81, it went up, but it started going up, I would say, from 1972, though. It took 8 years. So 72, It was 4.5%, and so it constantly trended up. There was some times where it'd come back down, but I mean, like when I say sometimes, I mean like a quarter. It may can't come down, but it constantly was trending up. So I'm assuming that that's what it is, and I feel like that's what's happening now as well, which is what we see. Like prices have gone up because interest rates were low. The only thing that is different is that I feel like this is kind of like penny stock, right? If you've invested in penny stock, you buy like a stock for a penny and it goes up a penny, it's doubled in value, right? And so, but if you buy a stock for a dollar and it goes up a penny, it's gone up 1%. So it's the same thing with interest rates where it's like, you know what, like if your interest rate was very small, it goes up a little bit, it makes a huge impact. Whereas if your interest rate's already like 10%, it goes up to like 10 and a half, it's not going to be the biggest problem. And so I feel like in a lot of ways, yeah, we may be the same as we are in the 80s, but we're also very different in that we're starting from a place where we're more fragile than we were in the 80s. Not to say the 80s was a better time, like it was easy, it was still very difficult. But I feel like we're probably in a more difficult time, but we do need corrections. We need corrections because interest rates are prices are way too high, and people just kind of bought just to get into the market, and you need to put that fear back into people so that they can think twice before they buy.
Yeah, no, I agree. I was just thinking about how what are the other kind of economic factors involved in really understanding the issue, and what are the differences between now and the 80s?
Yeah.
Because I know you mentioned before, and I've heard this opinion. I think it's more in the fringe mainstream opinion. It's not more of a mainstream opinion, but that they're going to reverse course probably by the end of this year, early next year, and interest rates are going to start dropping again, and prices will not crash.
Yeah.
So that if that were to happen, then we're not in a 1980s type of situation.
So 1980s, just for a little bit more of like a historical context, I do feel like the interest rates were coordinated with what's going on with the states. Okay, and at that point, we had a very, very, very different type of mindset within the states. Paul Volcker was probably I find like he's probably one of the sincerest Federal Reserve chairmans that I've seen, where he was not afraid to make hard decisions that was good for the overall country in the long run. Because after that, like successively, every single chairman's just brought interest rates down, started QE just so that like everybody's happy and that's it.
He got a lot of death threats for it, didn't he?
Yeah. So but because like you're ruining a lot of stuff, but it was because there was again so much money printing done in the 80s that there was a spike, there was an inflation that was going crazy that they had to tame that. So that's what they made some hard decisions. That meant that people had to kind of curb their appetite, right? They had to like really rein it in. We don't have that mindset anymore in the South, in the States, for our neighbor on the South, in the South. They're more thinking of, okay, we want to do more QE. Here's one great example also is that slowly since the 80s, the way the Federal Reserve calculates inflation has changed. So you know how it's like 8-9% now? If we were to calculate it, or if they were to calculate it the way they did in the 80s, the rule of thumb is it would be roughly twice as much. So we're looking at inflation of 18%, which means the interest rate should be around 25%, which is what people don't really kind of understand.
Just to play devil's advocate, though, so what you're saying is that they've replaced the basket of goods that were used to calculate inflation. But now, since then, since purchasing power has dropped considerably, incomes haven't increased in line with inflation, are people actually replacing those goods with those other goods maybe? Do you think that's possible?
I mean, people are replacing those goods. Firstly, they're replacing goods in that, like, hey, the issue was before, like, for example, in your basket of goods, you have steak. Let's say everybody's buying steak. Steak is, because I don't know anything, like 100 pounds, $100 a pound. Okay, let's just make this like simple, $100 a pound, and it's like it jumps to $200, right? So people say, hey, listen, I don't want to spend that much money. That's kind of crazy. I'm gonna move to chicken. Chicken is $50 a pound. Obviously, I'm not no anywhere near the prices, but just for analogy's sake, chicken jumped from 25 to 50, which means that things like I want to buy chicken. What the basket of goods is going to now show is instead of inflation of 100%, because you went from a $100 item to a $50 item, they're saying that your consumer behavior has changed and you want the chicken, not because you can't afford the steak, but because you want the chicken, which means that you went from $100 to $50, which means that prices are actually coming down. They got chopped in half. So it really depends on what kind of model you look at. And so that is not really it. Really, you have an inflation of, you went from an inflation of 100% to something that's bringing down the prices. So, and it's been done across the board with a lot of these things that we're like, how is it that year over year inflation is like 3%, but house prices are going up like no tomorrow, right? When that's your biggest expense. Gas prices are going up like no tomorrow. Like, how does that, because there's other numbers that they're using in substitution for it, which is what prevents you from actually looking at the real number. But that's a different story, and we could probably go on about it for a long time. It's probably good for another podcast. But back to kind of what we were saying, it doesn't take away from the fact that right now prices are high. And we definitely need to, we're going to have a correction, but that's not necessarily a bad thing. And that's kind of what I want to wrap this up with our top tip. The top tip for today that I wanted to kind of speak to all our mortgage brokers about, all our realtors, all our professionals in our network, that regardless of what's happening in the market, you should always be focused in on sales. And when I say that, I mean it doesn't matter whether you feel like the interest rates are going to go up tomorrow or down tomorrow. You should be out there promoting your brand, understanding how you're going to get leads in, understanding how you're going to get people in. Because I feel like a lot of people are like, you know what, I'm going to take my pedal off the gas a little bit just because market's not that great. Well, in reality, now is the time to actually get into the market, find new ways of getting in front of your customers and your clients, and making sure that you develop new systems and techniques in getting sales in, because only when, and I'll give you a very good example, whether it's stock, even real estate investors, right? The saying is like when there's blood on the streets is when it's time to buy. Okay. So when business is low, people are scared to make a decision. When I say people, there's professionals, you have competition. If they're scared to make a decision, that's when you make the move. That's when you got to be brazen. You got to be looking at different ways to get in front of different people, take chances, and keep pushing, because it's during these downturns that you can capitalize, you can monopolize in markets, you can actually find new and better ways of getting in clients. And then when you are in the upswing, you just put fuel on that fire, and it's just going to get bigger, and you're going to be able to hone that machine.
I agree, and I think what is missed in this conversation usually is that the sentiment is markets going down, less volume, less sales, interest rates going up. I don't think I'm going to get more business. But the context is the product you're selling changed, but you're still selling a product. So you were selling maybe, let's say, a 2% interest rate mortgage. Now you're selling a 3%, hypothetically. Everyone's selling that 3%, right? So your goal is finding that person that's looking for that mortgage and acquiring that client. You're working in the same competitive environment, and there's still volume in the marketplace. It's about understanding, how do I respond to the changes that happened and pivot my business, or take this risk, or push this sales strategy forward and capitalize on this opportunity, really, which is what it is at the end of the day.
Yeah, and you got to be creative. Like, one good example is you've seen a lot of digital mortgage brokerages opening up during COVID, because as customer demand and habits changed, you had a lot of people shift everything online, and they're making a killing.
Some brokers can't keep up despite the decline.
Yeah, because if you have a superior product, it's not like, you know what, there's nobody buying, right? You went from, like, let's say hypothetically 10,000 transactions to 5,000 transactions, right? If you're serious, you keep going. There's going to be a lot of people who are not motivated. They're going to be gone. They were messing up the market to begin with, right? If you've got like 10,000 transactions a month, and you've got like, and let's say out of the 10,000, you've got like 2,000 brokers that are taking advantage of those 10,000. And when the market was good, you just had like 1,500 brokers that were just kind of like just loitering, and they got some business because all you had to do was say you're something, and somebody threw you something, right? Because there's just so much business to go around, and 500 were serious. Well, now like a lot of those 1,500 that are like were loitering are going to be out. So now actually there's more business for the people who are serious, because the ones that were just kind of loitering, they're messing up the market. They're skewing it.
Yeah, no, I completely agree. It's focus on sales. That's the top tip. Focus on sales, and that involves the entire sales journey. We could go into this at length, but it's understanding that despite the drop in volume, there is volume out there. There is business being conducted, and it's the right mortgage brokers are the ones that are looking at this opportunity and figuring out where can I kind of showcase my brand, how can I improve my services and acquire that market share.
Oh, and that's a perfect way to end off things. Thanks for joining us.
Thank you, guys.
Today's episode is brought to you by Treston Associates. Treston Associates provides a growing suite of back office services to mortgage brokers. One of their most popular services is mortgage fulfillment. Treston Associates will handle the fulfillment of your files on a per file basis. No monthly fees and no commitments. You have a team of experienced professionals working for you without the headache and expenses of payroll, training, and turnover. Get in touch with Treston Associates today by visiting their website, tresstonassociates.ca, and book a call for a fee evaluation of your business. You can also click on the link in the description. Treston Associates is helping mortgage brokers scale their business. Contact Treston Associates today.